Many U.S. industries have relied on Mexico for imports like vehicles, auto parts, and machinery for years. And last month, Secretary of State Anthony Blinken hailed Mexico as an important trading partner.
We're really grateful to have such a close partner in Mexico, and that's borne out every single day in the work we're doing together in so many different areas.
By the end of last year, Mexico had eclipsed China as the U.S.'s major source of imports, with more than $36.6 billion in goods.
It's absolutely proximity. The United States is a capital-intensive nation, and our capital-intensive exports of, machinery and oils and minerals and such, going to Mexico is the driving force there.
But beyond the trade headlines, there are other factors as to why the trend has been for the U.S. to diversify.
The pandemic has exposed the risk of being overly dependent on supply from one country, in this case, in particular China, but also sort of a region. Companies, I think, have a great incentive now to not just diversify, but also secure their supply lines, to be more in control how supplies are routed and shipped.
The U.S. CHIPS Act of 2022, appropriating $52 billion to boost domestic semiconductor production, was part of the trend in U.S. trade.
We're looking at import substitution and export promotion policies that would make the United States competitive with nations like Taiwan and China.
And the shift in trade has been to other parts of Asia.
I think Southeast Asia is an area where that applies to. Vietnam in particular, Vietnam has been in the news also quite frequently recently as a recipient of new investment from American companies.
Increased tensions over Taiwan's sovereignty have contributed to America's decoupling with China. But the recent escalation of attacks on cargo ships in the Red Sea also has some countries looking for safer trading partners closer to home and out of harm's way. Frank Ucciardo, TRT World, New York.
Let's get some analysis now from Josh Mahoney. He's the Chief Market Analyst at Scope Markets, and he joins us now live from London. Thank you. So first of all, what does this mean for global trade, but also for the global balance of power? The fact that Mexico has now overtaken China in the volume of trade that it does with the world's largest economy.
Well, this says a lot about the so-called localization of trade. Of course, there has been a big focus in the past on just trying to find the cheapest producer around the world to be able to produce your goods, and that will give you the competitive advantage. What we saw over the course of COVID, of course, is that people really struggled with a lot of these supply chains, and we're seeing at the moment, we're seeing it with the trade through the Red Sea being interrupted, and there is a benefit to people bringing production closer to home. Of course, US is a high cost producer, so being able to have it on their doorstep is key. But one thing I wanted to highlight is that whilst we're seeing these numbers grow, in particular for Mexico, we of course saw that ramp up in tariffs under Donald Trump. That has not been reversed in terms of the US-China tariffs. And so there is a big question mark about whether this data is actually entirely reliable, where there is a benefit to US companies to essentially hiding a lot of the Chinese imports that they're actually obtaining with a view to trying to avoid paying the really significant tariffs that are in play.
Really interesting. Before we get to the nitty-gritty of Mexican trade and imports and exports, I just want to ask you, what are the risks behind this localization of trade, as you say, as opposed to being able to find the cheapest producer in China, in Asia, in other parts of the world? Are there risks?
I mean, there's always risks. I would say on this side, it's more of a known entity because, of course, the US has been trading with Mexico for some time now, and the ability for US companies to be able to invest on their doorstep actually sort of minimizes a lot of the risks associated with it. You would, of course, look at Mexico and say, well, isn't there a possibility that we see those wages rise and therefore the cost base increases alongside it? That certainly is a significant risk. But that also applies to China. As we've seen China grow, we've also seen them move out of being the sort of lowest cost producer out there. And so that's why you're starting to really see this shift of power, and US companies in particular starting to look for exactly where their money is best spent from a geographic perspective alongside just your baseline cost perspective.
Right. And is Mexican infrastructure going to be able to cope with larger activity at this point, led by exports to the US?
Well, we have seen increased sort of modernization of ports and roads and infrastructure alongside that. I mean, ultimately, anytime you see a significant ramp up in demand for something, you really need to be able to build the supply chain around it. And this is no different. We have seen the ports within the likes of Mexico suddenly becoming a sort of mainstay in terms of the hub and the trade route that then leads into the US. So it's something they're going to have to continue to work on. The increased reliance on any single country does increase the possibility of bottlenecks. But at the moment, it seems everything appears to be working relatively hunky-dory.